Governance in banks. The central authority involved in the governance of banks is the Reserve Bank, and most typically, the Reserve Bank brings in policy changes for the bank from time to time. Types of banking. Under this topic, the different types of banking business are discussed, namely universal banking, narrow banking, retail banking, and mobile banking. In universal banking, financial institutions and banks are allowed to undertake all kinds of activity of banking and development financing or any activity associated with the subject of development financing in compliance to statutory and other requirements prescribed by the Reserve Bank, governments, and related legal acts. Normally, in universal banking, the activities supported are granting loans, accepting deposits, investing in securities, credit cards, project finance, payment systems, remittances, insurance, and foreign exchange. Narrow banking, on the other hand, was accepted in India after submission of a report on capital account convertibility by the Tarapur Committee. Suggested as a solution to the problem of high NPAs and related matters, the committee proposed that incremental resources of the narrow banks are restricted only to investments in low risk assets like government securities. In narrow bank, the funds are placed in low risk free assets with maturity period matching its liability or any matching maturity profile, so that there are very less problems relating asset liability mismatch and any ongoing convertibility issues of assets into substandard assets. Retail banking sector is described as a sector having multiple products like deposits, credit cards, insurance, multiple customer groups like consumer and small businesses, and multiple delivery channels like call centers, internet, and branches. The main purpose of this type of banking is to increase penetration by providing added services to customers and offering them retail banking products and services. In mobile banking, banking transactions are done through mobile phones by customers of the bank who may debit or credit their accounts as permissible under Payments and Settlement Systems Act of 2007. Banks which are licensed and operated with physical presence in India alone are permitted to do this form of banking. Banks may also use business correspondent services for extending mobile banking facility where they remain appointed with RBI compliance. Corporate governance in banks. Corporate governance refers to conducting the affairs of a banking organization by following the best practice in a manner giving a fair deal to all concerned shareholders, who may be bank customers, regulatory authority, employee, and eminent members of the society. In India, however, the majority of the banks do not compete against each other but competes with other players in the banking system and financial service system, including mutual funds, in a new environment of globalization and liberalization. Corporate governance helps the bank to create an environment helping operating management enhance stakeholder values. It covers a variety of aspects such as protection of shareholder rights, issues concerning composition and role of board of directors, enhancing the shareholder values, prescribing the accounting system, placing monitoring mechanisms, as well as deciding upon disclosure requirements. In essence, the corporate governance in banks cover the following aspects, namely 1. Internal controls in the bank, 2. Constitution of board of directors, 3. Policy formulation in banks, 4. Naming committee of the board, and 5. Making transparency to all concerned. Bank authorization policy. In the first decade of the 21st century, the Reserve Bank of India, or RBI, brought in changes in its bank policy. As per the policy, a branch of a bank would include a full-fledged branch, a satellite office and an extension counter, an off-site ATM, administrative office, controlling office, service branch, and a credit card center. A call center will never be treated as a branch of a bank. The previously existing system was replaced by aggregated approvals on an annual basis through a method of consultative and interactive banking process. According to the bank policy, 1. A domestic bank other than RRB can open branches in Tier 3 to Tier 6 centers serving a population of up to 49,999 without RBI permission in each case. They can open branches in urban, semi-urban and rural centers in northeastern states and Sikkim without the permission from RBI in each case, provided adequate reporting happens between the branch and the Reserve Bank. 2. All underbanked districts of underbanked states should be served, and in that regard, RBI considers giving authorizations at least one-third of total number of branches opened in a financial year in these areas. 3. All domestic banks other than RRBs can open branches in Tier 2 and Tier 1 centers whose population is above 50,000 with prior RBI permission, except in the case of northeastern states and Sikkim. Procedures. Banks should submit on an annual basis detailed proposals for opening new branches for which prior approval is required in Form 6 in terms of Rule 12 of the Banking Regulation Company Rules 1949 and be sent to DBOB Central Office RBI Mumbai for approval. Banks can submit plans, in particular their annual branch expansion plan, which is approved by their board anytime during the year. It will be discussed with the bank normally within 4 weeks, and approvals will be communicated after such meetings with the bank authorities. Dividend payment policy of the bank. Banks fulfilling the prudential requirement of CRAR of at least 9% for preceding 2 years and net NPA of less than 7% can declare dividends. Banks not meeting the above norms but having a CRAR of 9% and above can declare dividends if net NPA ratio is less than 5%. Banks may declare and pay dividends if the dividend payout ratio shall not exceed 40%, and for profits for the relevant period, the payout ratio can be computed after excluding extraordinary items for accounting compliance with prudential payout ratio. Bank balance sheet disclosures. In making economic and investment decisions, the users of the financial statements of banks, such as shareholders, bank customers, government authorities, and employee, need information about financial position and performance of the bank. In that regard, the information they are interested in are the risks related to assets and liabilities and liquidity and solvency of the bank as it is drawn on its off-balance sheet or non-fund based items. In that interest, a full disclosure reveals useful information and is what really is given out by notes to financial statements, which is not necessarily part of the balance sheet of a company. Requirements of the disclosures. Reserve Bank of India has over a long period of time developed disclosure requirements allowing market participants to assess risk exposures, capital adequacy information, risk assessment processes, as well as key business parameters. These business parameters include business or profit per employee and return of assets, which has so far provided a consistent and understandable disclosure framework. This disclosure framework or system was achieved through revision of balance sheet and profit and loss account of banks, enlarging the scope to mention items that are included in notes to accounts. Currently, there are more than 52 items made part of the disclosure framework.